Let's begin with a fundamental idea. Behavior often outweighs technique when it comes to financial success. It's easy to get caught up in the latest investment strategies or financial techniques, but the reality is that your behavior plays a far more crucial role in determining your success. For instance, two investors can have the same financial knowledge, but the one who is more disciplined, patient, and emotionally stable is more likely to achieve better results. Consider this. How many times have you seen someone abandon a strategy during a market downturn? Panic selling is a classic example of poor behavior that can sabotage long-term success. It's the investors who stick to their plans and remain focused on their goals that tend to thrive over time. Understanding your own psychological tendencies and biases can significantly impact your financial decisions. Are you prone to overreacting in times of volatility? Do you struggle with the fear of missing out? Recognizing these behaviors can help you manage them and make more rational decisions. To improve your financial behavior, start by developing a clear investment strategy that aligns with your long-term goals. Stick to it, even when market fluctuations tempt you to change course. This discipline is what will separate you from those who get caught up in the noise. Think about your own experiences. Have you ever changed your investment approach based on fear or market hype? Reflecting on those moments can help you identify areas for improvement in your financial behavior. The power of time in investing. Now, let's discuss the critical role of time in investing. It's not just about picking the right stocks or assets, but how long you stay invested that often dictates your success. Many investors underestimate the power of compounding returns. When you allow your investments to grow over time, you benefit from compound interest, which can significantly increase your wealth. The earlier you start investing, the more you can leverage this powerful phenomenon. Consider this scenario. If you invest $10,000 at a 7% annual return in 30 years, that initial investment could grow to over $76,000. This shows that time in the market is far more valuable than trying to time the market. Moreover, staying invested helps you ride out market volatility. Historically, the stock market has shown a tendency to recover from downturns, and those who panic and sell during tough times often miss out on significant rebounds. To maximize the benefits of time in investing, establish a long-term investment plan and commit to it. This might include setting up automatic contributions to your investment accounts, ensuring that you consistently invest over time without letting emotions dictate your actions. Have you ever pulled out of an investment due to short-term market fluctuations? Think about the long-term impact of those decisions. Reflecting on your investment timeline can help you appreciate the importance of staying the course. The dangers of overconfidence. Lastly, let's address a common pitfall many investors face: overconfidence. When it comes to investing, confidence can be a double-edged sword. While it's essential to believe in your strategy and decisions, overconfidence can lead to significant mistakes. Studies show that overconfident investors tend to trade more frequently, often leading to poor outcomes. Take, for example, the investor who believes they can consistently outperform the market. This mindset can result in excessive trading, increased transaction costs, and ultimately lower returns. Overconfidence often blinds investors to risks, leading them to take on more than they can handle. One way to combat overconfidence is to regularly review your investment decisions and acknowledge your mistakes. This practice not only fosters humility, but also provides valuable lessons that can inform future choices. Additionally, seek out diverse perspectives. Engaging with other investors, financial advisors, or mentors can provide insights that challenge your assumptions and prevent you from falling into the overconfidence trap. Have you ever felt overly confident in a financial decision? Consider how that impacted your results and what you can learn from it moving forward. Now let's wrap up. We've covered some vital concepts today, focusing on the importance of behavior over technique, the role of time in investing, and the dangers of overconfidence. Understanding these principles can set the foundation for smarter financial decision-making. Thank you for tuning in, and I look forward to our next discussion on mastering your financial mindset.